Hello, and welcome to the Bank News Media webinar series, sponsored by Country Club Bank's Capital Markets Group. The Capital Markets Group is a fully registered dealer bank actively involved in the full range of investment products and services. The Capital Markets Group is recognized throughout the industry for their expertise, integrity, and service they provide to community banks. Our presenters today are Nicole Burzik and Shannon Emming. Nicole provides institutional investors with portfolio management, while Shannon works as a trader on the taxable trade desk. In this webinar, they will discuss defensive portfolio strategies to prepare your bank's portfolio to perform well in varied rate scenarios. The products and strategies presented will focus on ways to add flexibility to your portfolio and increase performance. We will have a question and answer period at the end of the webinar, so please submit your questions using the chat function on your screen. And as a reminder, this webinar is being recorded and everyone registered will receive a link to access the recording after the call. Now, Nicole and Shannon.
Thank you, Brian. We are excited to present today, and thank you everyone on the line for taking the time to log in and listen to us this afternoon. Shannon and I will be going through a series of market information and strategies to provide ideas to improve performance in your investment portfolio. Before I begin, I do need to take a moment to go over our disclosure. And this information in this presentation is intended for institutional investors only. The material provided in this presentation is for informational purposes, and we are not FDIC insured. No bank guarantee, may lose value. So without further ado, we work with the Country Club Bank Capital Markets Group in Kansas City. We work with community banks throughout the country in both the portfolio management and sales capacity. And we also provide community banks with asset liability management, mergers and acquisition activity, derivatives advisory, and other services throughout various subsidiaries throughout the country. And while we do have a large presence in the capital market space, we are first a community bank located in the Kansas City, Missouri side, and today we'll be presenting to you from Overland Park, Kansas, over on the Kansas side. So, in general, everyone is overwhelmed with a lot of data today, both bankers and the general public. We have so much data at our disposal nowadays that a lot of people have trouble focusing and knowing specifically what's important to their portfolio, their bank, or even to their banking customers. And it's easy to get stuck in what's called analysis paralysis. So today's not going to just be economic charts and graphs. We're going to do our best to cut through a lot of this noise and headlines to allow you to form your own rate forecast. As we go through the economic information, we're going to provide specific strategies and products for you to consider. Our goal is that after the call today, you will have a few key ideas that you can take away and implement in your future portfolio decision making. And please, as we talk through this, feel free to ask questions or comment in your chat box over on the side. We're happy to stop and provide clarity as needed. So let's start with the obvious. What's right around the corner and going to get a lot of press coming up soon, September 26th, is the next FOMC announcement. And it's a very fitting way to start this presentation titled Defensive Portfolio Strategies. So when we discuss defensive strategies today, we are referencing strategies to position the portfolio to adapt to changes in interest rates. And one of the main driving forces moving the yield curve higher since 2015 has been the Federal Reserve. As you can see, we've already seen 2 rate hikes this year. And there's been consensus from voting members for each of these rate hikes. There's been no dissenting parties. So the FOMC, which stands for Federal Open Market Committee, meets 8 times each year and has 12 members. There are 7 boards of governors and 5 regional Fed presidents, one who is the president of the Federal Reserve Bank of New York. So my favorite question from bankers is always, what is the Fed going to do? And that's usually a pretty easy one lately, because in an effort to be more transparent, we now get a lot of information from the Fed. And so far, since we have started normalizing policy, we really haven't been surprised. Jerome Powell just recently said in a congressional testimony, the Fed is firmly committed to a gradual pace of rate increases. So we also get speeches from various Fed members throughout the year in between meetings and a statement from the Fed on each announcement day. Then, 3 weeks after each meeting, we get a set of minutes. So you can kind of see here's a sample statement that we see from the Fed, and we'll go through and annotate them to show differences from prior statements. And the meetings are 12 pages long. So this quote right here is just a very simple quote showing just a sample of something that they would say in the minutes, but they go through their economic outlook and meeting consensus in more detail. So the Fed's giving us a lot of information saying they're committed to a gradual pace of tightening. And they're also giving us another tool to tell us exactly how much tightening we can expect, the dot plot. The dot plot shows several yellow dots, each which represent a member from one of the FOMC regional boards and the Board of Governors and their projection for the federal funds rate. Now, everyone speculates that this top dot is Esther George, while Jerome Powell and others that are moderately hawkish are kind of in the middle. And then James Bullard and Neil Kashkari are these two lower dots. But nobody knows for sure that those are the Fed voting members and which ones correspond with each dot. But it's kind of fun to speculate. They've recently gone on record, both Neil Kashkari and James Bullard, saying that they have some concerns with the Fed's continuing its tightening path. So things could change in the near future when they become voting members, and we could see a more dovish Fed purely due to voting member rotation in the next few years. But overall, the general trend for the dots is upward for the next 2 years and slightly higher from present rates for the long-term outlook. So if you look at this chart here, this is for 2019, the expectations, and that's slightly over 3%, about 325, a little bit higher at 325, 350 for 2020. And then the long-term outlook over here on this side shows their expectations for the future hovering somewhere between 275 and 3%. And that's important because the Fed is telling us that they're expecting rates to move higher, especially at the front end of the curve, which they control.
The WIRP page, or World Interest Rate Probabilities, allows us to analyze the probabilities of an interest rate hike and to quantify to what extent the hike has been, quote, priced in. As we know, we are now in the 1.75 to 2% range, and you can see by this graph there's a 99.8% chance that the Fed will raise to 2 to 2.25 at their September meeting, and a 77.4% chance there will be another hike in December. Generally, when the percentage is over 50%, it is telling us there will most likely be a hike, and the larger the percentage over that, the more the move has already been priced in. Said differently, this month's rate hike and most of December's have already been priced in, so if you have a cash position, you might want to go ahead and put that money to work now.
And what the Fed does do really does impact short-term rates. This is just a graph showing the Fed funds rate inverted here. In the blue line. So it's essentially the Fed funds rate flipped upside down, followed by the 2s to 10s one-year forward Treasury curve shown in yellow and 10s to 30s Treasury curve shown in white. And as you can see, the 2s to 10s in the shorter forward curve is much more closely correlated with the Fed expectations in the blue rate than the one in white. And it's especially important to note that this is a one-year forward curve. So there is a bit of a lag with what the market does corresponding to each Fed rate increase.
Another hot topic right now are liquidity needs. Country Club Bank is in their second year of offering our balanced CD program that has been very successful and makes a lot of sense. As a quick overview, you can issue virtually any size, $1 million to $250 million, with the maturity of your choice, even at a call if the maturity is 2 years or longer. We send this pricing grid out on a weekly basis. There have been two popular strategies lately. The first, if you are in borrowing or know you need year-end cash, why not lock in the 6 or 9 month levels, right now 220 to 235 all in, if the Fed is going to raise by 25 or 50 basis points later this year. Overnight borrowing costs will go up, and alternative funding sources are approximately 259 to 273. The second strategy that has been working is to lock the 4 to 5 year range with a callable, where you would be looking at a 3.25 to 335 all-in cost. As you can see on the grid, adding a call in these areas only costs you about 5 basis points. If you were to look at advances, you're looking at a 3.25 to 329. So the 4-year is exactly comparable, but with a CD you have a call option, and the 5-year is really only 6 basis points more expensive. A call date in these maturities are key, because if in a couple of years the market starts going the other way, you can call the bonds and reissue at a cheaper level.
So thanks, Shannon. And if you guys can look at this here on the screen, there really is not a whole ton of difference, maybe just a 5 basis point pay up between a fixed rate call or fixed rate CD and a callable CD. So if you issue a callable CD, you're only paying 5 basis points more for you to have the option as the banker to call this should you no longer need those deposits. Or, if you have an interest rate movement where rates are lower in the future, then you'd be able to call and refinance at lower rates. So where are we at today? This is today's current Treasury curve, and this just plots each duration on the bottom as well as the corresponding yield. So right now we have about 2.5% yield on the 1-year Treasury with 2.96 on the 10-year Treasury. And there's a huge change between where we are today and where we've been historically 20 and 30 years ago. But if you look at this chart here, we're fairly close to where we were just prior to the recession in 2008, graphed here on this red curve.
We were talking about noise in one of the starting slides. The story of the flattening yield curve has been popular all year. If you're on our PMR list, you have at least seen this topic one time because we wrote about it back in April. What does it mean? Will it invert? Does it mean there's a recession around the corner? I wish I had a crystal ball and could see the future, but here are a few things that we do know. The 2 to 10 year spread are at plus 21 right now, the 5 to 30 year at plus 23. History shows us since the late 70s, the 2 to 10 spread has dipped below 50 9 times, and 7 of those times that has led to an inversion. We've had 2 rate hikes this year. March 21st, we moved up to the 150 to 1 3/4 range. 2s to 10s were a 57 at that point. On June 13th, we moved up to the 175 to 2% range. 2s to 10s were a 39, an 18 basis point change each time. If we're sitting at 21 right now, and this pattern repeats itself, if the Fed sticks with 2 more rate hikes this year, we could invert at the end of this year or beginning of next, something we need to keep our eye on.
Here's just a zoomed-in view of what this graph Shannon was referencing. But as you can see, we do have an extremely flat yield curve, and there is very minimal difference between the 2s to 10s and 5 to 30s. And there's not much variance between the two graphs as you move throughout history. So regardless of which specific index you're looking or tracking, you're going to get fairly similar results, and both can indicate a flattening yield curve. The 2s to 10s does tend to be more responsive to changes in interest rates and more predictive just because the Fed typically is involved in that and they have more influence over the front end of the yield curve. So what should you do as a banker if you think interest rates are moving in an upward direction? Well, you've got a couple options traditionally to pick up yield in your portfolio. You can either extend duration or you can decrease the quality of assets to pick up significant yield. And in today's marketplace, you have a fairly unique opportunity because the yield curve is so flat. You're able to make pretty huge dividends by just being an active participant. So a lot of bankers, probably on this conference call as well, have a bond somewhere in their portfolio that's lower than the 1-year Treasury at 2.5%. You probably have a holding that plots somewhere in here on this graph. You have an opportunity that's fairly unique today because you can sell that at a slight loss and still be able to pick up investments without having to decrease quality that offer some significant spread to the yield curve. And today we're going to go through a couple specific strategies of how to do that. But the most common and the one that we favor above others in a rising rate environment is a barbell strategy. The barbell strategy traditionally just means that you take half of your investments and you invest on the front end of the yield curve and the other half and go out longer. Now, where that specific maturity date range is going to be will vary from bank to bank depending on your specific investment strategies, and you can kind of pick where this end of the barbell will be or where this front end of the barbell will be, but essentially the thought process is very consistent between the two. The first, in the front end of the yield curve, allows for cash flow. Essentially bonds you're going to buy that are short, that are either going to provide cash flow or have short maturity dates to allow you to invest in rising rates. The long end is going to allow you to boost portfolio yield. And so what you're doing by balancing both of these strategies is really providing your bank with risk-adjusted returns. So you might sacrifice a little bit of yield up front, but you will make it up by the bonds that you place on the longer end of the barbell, which should provide more yield.
This is just a look at the generic 2-year Treasury. The Fed raising rates has put an upward pressure on the short end of the curve. The Fed raised for the first time in December of 15. The 2-year was a 0.96. We've gone up 179 basis points to 275 in the last 2.5 years.
And the 10-year is moving in a fairly similar fashion. As you can see, that's graphed here in blue. Each of these red bars represent recessions, which is essentially just a fall in GDP for 2 consecutive quarters. Basically, where we're at today is still well below where we were prior to the last recession by about 100 basis points. We're hovering about 2.96 on the 10-year Treasury today. And prior to entering that recession in 2008, we were just above 4%. But it doesn't really matter which specific Treasury yield that you're tracking. Historically, now this is a very long dated outlook of the Treasury yield, but historically, they have all trended in a similar fashion. And granted, there are some points where you see a little bit more spread between the 2s and 10s and 5s and 10s. The 10-year yield curve graphed here in blue, while the 5-year is graphed here in red, and the 2-year in green. But as you can see, overall, we've had a 36-year bull market lately, and yields have just been trending lower. Now, the question is, have we entered a meaningful bear market? And if we do think rates are going higher, what can we do to position ourselves to better take advantage of that today? And this is the last recession, was the deepest, both in the U.S. and internationally, since the Great Depression. So we've been in a pretty deep recession for a while, and then now just beginning to see recovery. As you can see, throughout the last 36 years here, as we've been moving downward, as we've been moving down here in yields, you've been able to put bonds on your books and have market values in your portfolio just appreciate. You haven't seen a lot of losses, and you've probably had a lot of gains. Now, as rates have started to increase, what we're seeing is some banks have unrealized losses. And at least in the near term, this is trending upward. So it's going to pay to be a little bit more active in your portfolio management, because bonds that you could typically hold on to and do nothing would just increase in value. And today, that's not the case. So one strategy we have looking at increasing interest rates is to consider using variable rate products. This example is of a floating CMO, which is just a CMO where the coupon periodically resets. This is an example of a Ginnie Mae floater that's completely expected to pay off by 2034. If you can see at this cash flow chart here, you see a lot of cash flow at the first few years and then slowing down in the later years. This particular bond is extremely seasoned, has a 2.49% coupon right now, but does make sense for a lot of investors because this moves up and down according to its specific index. And I know CMOs can be intimidating to some bankers, so I'd like to suggest something at the simpler end of the range, like a PAC or sequential, and then work your way up to something with this specific structure. But we're here to break down these products into specifics, and we can go through the prepayment history, specific structure, and cash flows with you at any given time.
Here we're taking a look at the LIBOR and CMT indexes, because as we talk about variable rate products, we need to take a look at what they're indexed to. Both of these have steadily climbed over the last year as well, and moving up quicker than prime. Also in the news is a newer index, SOFR, Secured Overnight Financing Rate. As LIBOR is supposed to get phased out by 2021, SOFR is now in the spotlight. As of April 3rd, 2018, the rate is now published daily by the Federal Reserve Bank of New York in cooperation with the U.S. Treasury Department's Office of Financial Research. There have been a few small floating rate notes issued indexed to SOFR, and so far the pricing differential between SOFR and LIBOR is minimal. LIBOR is a $350 trillion market that will be transitioned over in several stages. ARMs are, relatively speaking, a small piece of that market that will adopt either SOFR or CMT as an index.
So as Shannon mentioned, another floating rate product is an adjustable rate mortgage, which is an ARM, and these do vary based on the index of LIBOR, which is graphed on this prior slide in blue. And essentially what happens with an ARM, which is an adjustable rate mortgage, is that it adjusts its coupon, which is currently 279, based on LIBOR plus its margin. And LIBOR is its index, and its margin is 162 basis points, so 1.62%. So this security will move up in coupon from 279 to LIBOR plus 162 basis points. And it will vary based on what LIBOR is at its specific reset date. So this is a season 7-1 ARM. So in 2024, it will have its first reset date. At that point in time, it can reset in coupon up 5 basis points, down 5 basis points. Every year thereafter, it can go up or down by 2, and then to a total cap over its lifetime of 7.79%. So your coupon on this security is adjusting up and down, which makes it great as a product going into a rising rate scenario. If you expect rates to be higher, you can expect that your coupon is going to adjust upward. Now, a lot of banks typically don't consider this type of product because historically you've had to sacrifice some yield in your investment up front compared to other cash flow products like mortgage-backed securities and things like that. However, today you can purchase the same bond at a discount with a yield of 3.34, which is extremely competitive with where the market is for similar securities at a similar weighted average life and duration. So the thought process behind ARMs are going into a rising rate scenario. If you're an investor and you have a mortgage and you own your home and you have an adjustable rate mortgage, as rates go up, you'll get closer to your reset date and you'll be incented to pay down your mortgage more quickly and prepay your mortgage to avoid having to enter into one of these reset scenarios where you'd be paying a higher rate to maintain the mortgage on your home. And so comparatively to a seasoned pool, the ARM should perform better in cash flow and higher rates. This is evident by just the difference in the change in average life, up 300 basis points on comparing an ARM and a seasoned pool. This seasoned pool starts out with a much shorter average life, but if rates are expected to go up 300 basis points, it extends out much further. Conversely, this ARM, and this is the same one we just looked at the prior screen, actually reduces its average life if rates go up 300 basis points instantaneously. And you can see it has similar effects on duration. Now, to really put this in perspective, we'd like to go through just the specific cash flow differences between the two products. This is an ARM over here on the left side of the screen and a seasoned 20-year 3.5 pool over here on the right side. As you can see, we're starting out with very similar current face on both the ARM and the mortgage-backed product. Both have similar coupons, 2.79 on the ARM for the first 4 years and 3.5 over here on this pool. The ARM is great because you get a big portion of your cash flow back in the first 4 years, and then while it does extend out to a longer final maturity date, you're doing so with already having received a bulk of the principal. Whereas the mortgage-backed pool does also provide great cash flow, just not as significant of an amount in the first 4 to 5 years, especially in this 5th and 6th year as you approach the reset date on the ARM. Now, all of these are just projections and predictions and based off assumptions of what typically happens in a rising rate scenario. But cash flow is extremely important to investors, particularly when you're talking about going into a situation where you have rising rates. It's important to get cash flow from these types of investments so that you can get that back and reinvest as rates move higher. So to recap, ARMs are a great cash flow product, and they're expected to pay down quicker in a rising rate scenario. So now that we've talked about ARMs and CMOs and adjustable rate products, let's take a look back at traditional bank products and how they're stacking up today.
Here we're looking at an agency spread to treasuries back in 2016 versus 2018. And as you can see, as we've continued climbing in rates, agency bullet spreads to treasuries have tightened quite a bit over the last 2 years. Supply and demand is the biggest reasoning behind this tightening trend. Fannie Mae and Freddie Mac are still trying to shrink their balance sheet, and Home Loan has been using floating rate notes as their primary source of funding, keeping bullet supply very low.
And so in traditional bank products, such as agency securities, you do have these bullet options, which, as Shannon mentioned, have really narrowed their spread to treasuries, the blue line being the agencies and the green line and yellow line respectively being the treasury yields from 2016 to 2018. And so another product that a lot of bankers like to consider utilizing, and people have done so quite frequently in rising rates, especially recently, are callable bonds. And these are callable agency bonds graphed here, just above the agency yield curve on the front end of the curve, and then offering more spread out longer. So when you're looking for a product to fill in that longer end of the barbell, agency bonds are a great option, and particularly callables, because they do offer more significant spread to treasuries as you get out to this 10-year point. Now, the caveat with callable bonds is if you're investing in callable bonds, you're making an interest rate call that you think rates are going to continue to move higher in the future, thus justifying the spread, and you're picking up the yield. But they will get called on you if rates go much lower and the issuer can call the bond, and often they get called exactly when bankers do not want to have them called. So another option above and beyond agency bonds or callables that's very appropriate for a rising rate scenario is mortgage-backed pools because of the cash flow that they provide. You can see here in red, this is an agency security, and just a bullet. You have all your interest payments each year going out to 2026 when you'd get returned the full principal amount. Then, graphed over on the right-hand side is a mortgage-backed pool, and this is a seasoned 15-year 3.5% pool. As you can see, in the first year, you're going to have $75,000 in scheduled principal, $123,000 unscheduled principal, $36,000 in interest, to have a total cash flow that year of $235,000. That gives you the total cash flow over the life of the security of $235,417, this number over here on the right. And every year as you go on, you're going to continue to get principal, and both scheduled and unscheduled principal, as well as interest payments back more quickly, providing cash flow in these amounts over here. Whereas if you were in a bullet structure, you're not getting any cash flow of principal and only your coupon and interest payments. Essentially, by 2023, 5 years from now, you'll have received back $959,000 on $1 million initial investment, whereas in a bullet structure, you would have only received your 5 coupon payments. Now, this allows you to extend out longer in these products, but still get cash flow. So you're not sacrificing total yield, as both of these securities have very similar total yields initially. Another product that bankers like to use, and we get asked a lot of questions about recently, are taxable municipal bonds. These are the two graphs that Shannon provided earlier when she was talking about bullets and agencies. And the other main staple in bank portfolios are municipals. So taxable municipals are graphed here on this slide in red, and they offer significant spread to both treasuries and agencies across every maturity range on this board. And this goes all the way from 1 month out to 30 years here on this graph. So really at any point on this graph, a banker could choose to incorporate taxable municipal bonds and pick up spread over treasuries. Now in the barbell strategy, that would be either out longer or on these shorter dated maturities, but there is a benefit to taxable municipals throughout the course of the yield curve. And this compares to traditional municipals, in that traditional municipals graphed pre-tax are down here in this purple line. Your taxable equivalent yield to get you from the purple level up to the red level will depend on your tax bracket. So if you had a 21% tax bracket and you were investing in a 10-year muni, on this graph, pre-tax, you'd be just above the Treasury curve. However, your taxable equivalent yield would plot your point somewhere significantly higher at about 3.5%. And that's what we did right here, is we just took 2 municipal bonds and graphed where they would be on a taxable equivalent yield basis. So this is the 2016 yield curve, this is the 2018 yield curve, and here's just where 2 BQ munis would fall. Now, in the middle of the curve, that's a great way to pick up a little bit of yield, but you're also outside of the barbell strategy. So in the middle of the yield curve, you're looking at being right on this steepest part of the yield curve, and that's a great place for most bankers to start considering the use of municipal securities in their portfolio, just because the taxable equivalent yields do offer spread to treasuries and agency products. So we'd like to, at this time, open it up to any questions anyone may have. Feel free to send us a question over in the chat, and I think Brian will read them back to us.
Okay, great. Thank you very much. Thank you, Nicole. Thank you, Shannon. One of the questions was asked at the very beginning, and I'll pose this. This is actually about the presentation. As a reminder, it has been recorded, and everyone who's attended the call will receive a recording of the call. But one of the questions, Shannon, Nicole, that was asked, can the attendees actually receive a copy of the slide presentation that you've provided?
Yes, we'll plan to email it out to everyone in attendance here after the call today.
Thank you. And as a reminder, for the question and answer period, you can just submit your questions through using the chat function on your screen. We did have one question that went through during the presentation, Nicole and Shannon, so let me read this out. If the curve is about to invert, have we not already been in a higher rate scenario? That's one of the questions. It's actually a 2-part. we will want to expect rates to go up 300 basis points, or rather have a recession in 1 year, and rather have a long fixed rate investment bullet rate rather than adjustable rate amortizing product?
Yeah, sure, Brian. So we can't see the question here on the end, but I think the question is, if rates are already at this high, do we think that you should still be using a barbell strategy, even if the curve could potentially invert? Is that correct?
Right. Yeah,
Okay.
if the curve is about to invert, have already been in a higher rate scenario.
So yeah, rates are obviously a little bit higher than they were before. An inversion can signal a recession and is an indicator of that. However, the Fed is still telling us that rates are going to continue to move higher throughout the next couple years. And so that's why we really do like that barbell strategy, because not only are you saying in the next 2 years we think rates are going to go higher, but you're also hedging your bets that we could be at the highest point in rates with the longer end of the barbell strategy, saying if this is the peak, we still have picked up that much yield by going longer. And a key to note when we were talking about all those mortgage-backed securities and callable munis and agencies that offer spread to treasuries is we're not saying buy short and sacrifice yield. There's plenty of good options out there that still do provide cash flow on that front end of the curve, to cash flow into higher rates, or in lower rates, you're still seeing significant yield and you can reinvest, hopefully both ends of the curve before you get to lower rates.
Okay. Thank you. Another question. What is your outlook on rates for the next few years, and how long do you think the Fed will continue to raise rates?
So my outlook is fairly consistent with what we put in the presentation, and lines up pretty clearly with the Fed's outlook. They're pretty much telling us what they would expect to happen, and that's higher rates here for the next 2 years in 2029, 2020, and then potentially some longer term adjustments. Now, there's a lot of things at play. Tariffs could have a meaningful impact on corporate earnings. And really, if we enter in a full-fledged trade war, we could see a recession sooner than we think. But as far as what economic indicators are telling us, what the Fed's saying, we do have an outlook for rising rates in the next few years.
Okay, very good. Thank you. Another question that just came through. Should investors continue to utilize variable rate products this late in the business cycle?
Yeah, so Brian, that goes back to the first question that you had kind of asked us. And if you can handle the extension risk, if rates rise in a variable rate product and model both up 300 and down 300, then if rates do decline, you could have some extension in a variable rate product. But more importantly, you really should have diversification throughout your entire portfolio and look to utilize just a mix of products, both on the short end and on the longer end of the curve.
Good. Another question, since you talked at length regarding adjustable rate mortgages, why do you prefer adjustable rate mortgages or ARMs and variable rate CMOs above other adjustable rate products?
Yeah, so typically why we look to use CMOs and ARMs relative to other adjustable rate products like SBA pools, there's a lot of different student loan bond structures, things like that, is mainly for the liquidity. But the secondary trading market for both of those products is fairly strong relative to other adjustable rate products. So that's why we tend to favor both ARMs and CMOs above those products and use those as a starting point in this presentation.
Sounds good. Well, again, Shannon, Nicole, thank you very much for this wonderful presentation today. And again, as a reminder, the webinar has been recorded and everyone who's registered will receive a link on access the recording after the call, but also a copy of the presentation slides, which will be available on the Capital Markets Group site. We'll have information on that later. So this concludes today's webinar. I appreciate everyone's participation. Okay.